Thanks for coming back to the Patrick Lane Show, where we talk about personal finance, investing, and real estate. And today, my goodness, what a depressing day. GameStop has crashed and burned after yesterday's earnings report came out. And frankly, it wasn't as bad as what everybody thinks. But first, before we talk about that, do me a favor right out of the gate. Smash that like button, hit the subscribe button, ring the notification bell if you would, please. We really appreciate your help in growing the channel. And today we're going to follow up on yesterday's earnings report from GameStop. Now, if you remember from the video, or if you've heard the news, GameStop reported and it missed its earnings per share estimate by 1 penny. And it was off on its revenue for the fourth quarter of 2020 by about 112 million. So that's decreased from what the estimate was. But if you think about it, I mean, we're dealing with the pandemic. We're dealing with all of the issues with store closures. So it's not unanticipated. It's not something that we shouldn't expect for any retailer to have an off year with the pandemic going around, everything that was happening in 2020. So what does it mean going forward? Well, you know, obviously people saw that, and if you had paper hands on GME, then guess what? You saw a 1 penny miss and a little bit of a revenue miss and sold off. So the stock went from 200 or close to it yesterday to 145, down 20% today. And you know, there's no way to explain that other than people saw the earnings report. They didn't like what the earnings report said, and they decided to paper hand and sell off, which drove the price down, of course, right? You know, one of the other things that it could be that people are concerned about is there was a note in another one of the 10K filings yesterday that talked about how GameStop is still considering selling more common shares at the money, and the reason that they would do that is to try to fund their transition to the digital e-commerce giant from the brick and mortar platform that they have right now. And so it's a little bit of a mixed bag when it comes to that. You know, people are worried that if they sell the shares to raise the money, then that means that our shares that are out here being held by retail investors are going to be diluted, right? So that's one of the things that may have caused that sell-off as well, that 20% drop, because people think that there are going to be additional shares out there diluting our share value. But if you set those two things aside and you don't go into sort of the headlines and all that sort of thing, and we look at some of the actual numbers and the information that was presented beyond the top line, then I think there's a lot of good news that could be positive going forward. Now, you know, obviously if today is just a down day and we've got to get past that, but if you're a diamond-handed holder for GameStop, I think there's some good news in the filings that were presented yesterday. First of all, it's clear that the company is on its transition track. You know, there was some language in the report that they wanted to be, you know, the #1 e-commerce, customer-obsessed gaming retailer in the world. And they're going to provide that through an e-commerce and technology platform, which is exactly the kind of thing that most of the people who have invested now in the last few months are looking for, is that transformation from brick and mortar to e-commerce giant. Along with that, some of the other numbers showed that, you know, same-store sales were up over 6% year over year. And also, interestingly enough, the e-commerce sales at GameStop were up 175% year over year in the Q4, but also up 191% year over year. So for the entire year, they were up 191% in e-commerce sales, which is a fascinating and important number considering that's where this is really going to head. The other thing that's important to understand is that there were more filings regarding how the board is going to be made up and the executive team going forward. So if you remember, Jim Bell was pushed out a few weeks ago as the CFO, and the idea was that they were looking for a CFO who was technology focused, growth focused, e-commerce focused. Well, they've got somebody in that position now who they promoted from within to act as the interim, and that person has a background in technology, obviously. So there's also a chief operating officer who has come on, and she has a background in working in technology companies who have been focused on delivering e-commerce results. And so those are two very, very good newsworthy bits of information from the executive team. And then we find out in the filings that, guess what? The board, which is currently a 13-member board, is going to be reduced down to a 9-member board. Okay, and not only is it going to be reduced down to a 9-member board, but of the board members, 8 of the current board members are expected to retire off of the board soon. And so, just basic math, 13 board members minus 8 of those board members leaves 5. And guess who those are going to be? It's Ryan Cohen. It's the 2 people that he brought in with him who have e-commerce technology backgrounds. It's the activist investor who was there from Hestia Fund, Kurt Wolf, who was trying to start this e-commerce transformation even before Cohen came on board. And it's the current CEO, George Sherman. So those are the 5 who are left after the 8 are going to be retiring. And then you've only got 4 spots left to add to the board. And so it looks like those 5, if they're all in agreement as to how fast and what type of a transition and direction GameStop needs to take, it looks like they're going to be the controlling board members going forward. So that's an interesting development that I don't think has gotten any or very little respect for it being a transformational boost to what we're going to see as far as the changeover for GameStop. So that's a lot of, I think, very good information. Now, everybody who is downplaying this and selling off and paper handing GameStop and just wringing their hands about it and causing it to drop 20% and saying, oh, it's over, it was no good to begin with. We've got to look at the market share, right? GameStop, the gaming industry and gaming retail in the United States is about a $60 billion market. Well, if you compare that to, for example, Chewy that Ryan Cohen started, right? You've got Chewy over here in about a $30 billion market space for the pet food, pet supply market space. And so that, if you think about that, you're talking about Chewy that has a $30 billion market. They've got about 18 million customers. And then you compare that with GameStop that has a $60 billion market, addressable market. And just in the rewards program at GameStop, there are 20 million customers. And so we've got a lot of sort of momentum and room to grow for GameStop. And if you think about comparing the prices or the market caps, we've got Chewy with a smaller market at a total addressable market that has a market cap of $30 billion. And you've got GameStop, which has a larger total addressable market in the US with a market cap of about $13 billion right now. So it's not that GameStop doesn't have room to grow. It's just that we're not looking at these things as an apples to apples comparison. People out there who are downplaying GameStop don't see the potential. They're not factoring in the potential. They're again still looking at a brick and mortar store that they think is going to close because nobody wants to go walk in the store. And to a large degree that's true, but they also are not looking at the positives when it comes to turning it around. The strategy that the board and the leadership team are taking, the emphasis on e-commerce, and frankly the growth of their e-commerce revenue, 191%, before they really even focused on it and growing it out. And with that built-in 20 million customer base of the loyalty program, I think it's going to have room to run. There's a long runway for this to get to a bigger company. Now, of course, it has to compete with Amazon, Walmart, Target, and those big box stores and online retailers that are, competing in that same field. But as a specialty retailer, much like Chewy, GameStop is going to be able to make the important improvements and zero in on what the customers really want. So that's what we've got today. We've got GameStop crashing and burning, but I think that they crashed and burned because the paper hands got out. Tell me what you think. Is GameStop going down 20% today? Is that a reflection of the actual value of the company? Is it that the price ran up too much? Is it just paper handers letting go? What do you think? Let me know in the comments down below. Do me a favor, smash the like button, hit the subscribe button, ring the notification bell. We really appreciate your help in growing the channel, and we'll see you in the next video.